Welcome to Sheen Research, your strategic partner in uncovering untapped business potential.
Today we are taking a look at Natural Grocers by Vitamin Cottage, ticker NGVC.
Right, and we're going to investigate their financial results from the third quarter of fiscal year 2025. That's the period that ended on June 30th.
And the real story here, I think, is resilience. They faced a pretty massive operational shock this quarter, so we want to dig into how they handled that and, how this Q3 compares to the really rock-solid Q2 they just had.
Okay, so let's jump right into the Q3 headlines. The quarter showed some phenomenal durability. Net sales hit $328.7 million.
Which is a solid 6.3% increase compared to the same time last year.
A very solid increase, but that number is actually hiding a pretty big challenge they faced.
It absolutely is. You have to remember, this was the quarter of the big UNFI cybersecurity incident. United Natural Foods is their primary distributor.
When a partner that big goes down, that has to hit the shelves almost immediately.
It does. And management actually put a number on it. They figured net sales took a hit of somewhere between $3.5 and $4 million because of it.
Wow. Okay, so that's the central conflict of the quarter then. Because despite that supply shock, their profitability just soared. Net income was up 26.0% year over year.
Mm-hmm. And diluted earnings per share hit $0.50. That's up from 40 cents the year before.
And again, that's with the disruption.
Exactly. Management estimated that whole UNFI issue probably cost them about 4 to 5 cents in diluted EPS. When you look at the other metrics, the strength is just so clear. Operating income jumped 21.3%.
And the adjusted EBITDA. That's always a good proxy for their core cash flow.
Right. That hit 7.4% of net sales, climbing just over 10% from last year.
But the real story, I think, for customer behavior is always in those comparable store metrics.
For sure.
Daily average comparable store sales, they were up a very healthy 7.4% for Q3.
And the breakdown of that is what's so fascinating.
Yeah,
Well, 4.8% of that growth came from the daily average transaction count, so more people. The other 2.4% came from the transaction size, the basket size.
So it means more people are choosing to shop there. It's not just inflation driving up the numbers. That signals, real market traction.
It's the engine of their growth. It suggests better loyalty, more traffic.
Yeah.
And, they're sitting on a good amount of cash, too.
Right. They approved another quarterly dividend. What was it, 12 cents a share?
Yep. And they have about $13.2 million in cash, plus almost $70 million available to borrow. They're very liquid.
Okay, so to really understand the impact of that shock, we need to look beyond the year-over-year numbers. The real test is, how did Q3 look right after the momentum they had in Q2?
And that's where you see it. You see the impact of that June supply chain disruption almost immediately.
A clear sequential deceleration.
A very clear one. Net sales, for instance, they dipped from about $336 million in Q2 down to $328.7 million in Q3. Net income followed that same path, dropping from $13.1 million to $11.6.
And that momentum slowdown, it's clearest in that core operating metric. Daily comp sales growth went from an incredible 8.9% in Q2 down to 7.4% in Q3.
And it's so crucial to attribute that correctly. Management was very clear that the fallout from the UNFI incident probably knocked about 1.0 to 1.5 percentage points off their Q3 comp sales.
So the fact they still managed 7.4% is actually quite remarkable.
It really is. And the good news, for investors anyway, is that management said operations have, quote, substantially normalized as of early August.
So the slowdown was external, it was temporary, it wasn't a sign that customer demand was softening.
Exactly. And the cost structure between the two quarters really backs that up. Gross margin held pretty stable. It was at 29.9% in Q3, which is, almost the same as the 30.3% they saw in Q2.
They weren't forced into any deep discounting to move product.
Not at all. And their store expenses as a percentage of sales, that stayed consistent too.
And I noticed pre-opening expenses were way down.
Negligible. Which just tells you they slowed down their new store openings a little bit during that quarter compared to last year.
Which makes sense. So just before this UNFI thing hit, management was feeling pretty confident. They said they weren't seeing any signs of softer demand, no trading down, no fewer items per basket.
Right. Their strength seems to be in that really specific product mix they have. Things like 100% organic produce, pasture-raised dairy. That differentiates them.
Okay, so that brings us to the operational drivers that are really underpinning this resilience. Their loyalty program, NEB Power, that has to be a massive strategic asset for them.
It's huge. The net sales penetration from that program hit an incredible 81%.
81%,
Yeah.
That's up from 78% just a year ago. that kind of penetration rate, it gives them this high degree of predictability and, influence over what customers are buying.
And they're not just giving away discounts. They're driving repeat visits with tailored offers, a 1% rebate, and special pricing on staples like eggs and avocados.
That's how you maintain transaction count growth, even in a quarter with major disruptions.
Absolutely. The other big driver is their private label program, Natural Grocers' own brand.
How's that doing?
It accounted for 8.6% of total sales, which is up slightly, and they launched 22 new branded items in Q2. Pushing that private label share is just vital for them to control their margins.
And their delivery strategy, that seems pretty lean.
Very lean. Instacart sales are holding steady at about 2% of total sales. Management seems to prefer using a third party for delivery. I think they see bringing it in-house is just too expensive.
Smart move to protect that margin profile we were just talking about.
So with all this operational strength, it's no surprise that management was confident enough to raise their guidance pretty aggressively, despite the Q3 blip.
That was a big tell. They updated their full-year comp store sales growth target up to a range of 6.5% to 7.5%.
Yeah, that's up significantly from the prior range of 5% to 7%.
That is just a massive statement of faith in the business momentum. It suggests they fully expect to recover any lost sales from that incident in Q4.
They also boosted the full-year diluted EPS guidance. They moved it up to $1.78 to $1.65 before. A huge boost.
A huge boost. Now, there is one slight mixed signal in all of this.
The store expansion plans.
Exactly. They did temper their expectations for the year a little bit. They revised the new store outlook down from 4 to 6 openings to just 3 to 4.
But they kept the long-term goal of 6 to 8 new stores per year, right?
Yeah.
And they're still planning to spend between $36 and $44 million on capital expenditures.
Right. So the investment commitment is definitely still there. It just seems like a short-term adjustment.
Okay, let's talk about the external context for a minute. The usual macro risks are still out there. Labor market, inflation, general supply chain issues.
And they also specifically called out the risk of new tariffs on goods from places like China or Mexico. They said it hasn't had a material impact yet, but it's a risk factor they're watching. Finally, let's touch on some structural factors. We should note the related party real estate transactions.
Right. The company leases several of its store locations from trusts and properties that are connected to non-independent board members and the founding family.
So simply put, management is paying rent to entities that are owned by family members. It's not uncommon in a company like this, but it's a structural feature you should be aware of for transparency.
And from an external view, Wall Street seems to have a pretty strong outlook. CFRA recently issued a BUI recommendation on the stock. They rated the risk as moderate.
And the valuation metrics? They suggest the market shares that confidence. The current price-to-earnings ratio, the PE, is sitting at 21.5.
Which is pretty high for them. Their 5-year average PE is closer to 15.1.
So that gap tells you the market is really pricing in that guidance raise. They're expecting accelerated growth in the future.
Exactly. It means there's not a lot of room for error if they want to hold that valuation. But historically, the performance has been fantastic. A 5-year total return CAGR of 37.1%.
So, to synthesize everything here, NGVC showed exceptional underlying strength in Q3. Despite a quantifiable short-term hit from the UNFI incident, the core drivers, especially that transaction growth fueled by 81% loyalty penetration, were strong enough for management to significantly raise their full-year guidance.
The big takeaway is that the operational model is just really sound. I mean, the 8.4% comparable store sales growth they've achieved over the last 9 months proves that. The challenge now is balancing that internal excellence with their plans for external expansion.
Which raises an important question for you to consider. Given the impressive resilience Natural Grocers showed during this Q3 disruption and their long-term goal of scaling up store expansion, how effectively can they sustain this high rate of comp sales growth while also executing an accelerated new store strategy without, straining their resources?
That balance between organic growth and physical expansion is going to define their story over the next couple of years.
With that, we conclude our coverage for this video. Thanks for joining us. Sheen Research, Mindful Markets, Measurable Meaning.